comparative financial statement analysis. What we're doing here is comparing. And we're going to use this analysis to compare different financial statements. And the situation that we have is that we often need to compare companies that may be of a different size. One company is just 10 times bigger than another company, so all the amounts are going to be bigger. We also may need to compare the same company over a period of time as that company grows or gets smaller. So as the company grows, the fixed assets are going to become more. Revenue is going to become more. Cost of goods sold is going to become more. But the question we're kind of looking at is, as the company grows or as that company gets smaller, are the financial statements, is the information in the financial statements still kind of in line with what we would expect? Does it kind of balance as the company grows or as the companies get smaller? Are fixed assets going up at an appropriate amount? Are the receivables going up at an appropriate amount? Is inventory going up in a reasonable amount considering the rise in revenue? And so we have two tools that we're going to look at. We're going to look at vertical financial statements, which are also called common size financial statements, and horizontal financial statements, which enables us to do trend analysis. And so what we're looking here is the tools that we have available to us to help us compare companies that are of a different size and also to compare a company over a period of time. So we start by looking at vertical or common size financial statements. And this is a situation where our common size financial statement covers 1 year of operating results. And we're going to put each component of the financial statement as a percentage of a total. We're going to have the dollar amount, but there's also going to be a percentage of a total. Generally, line items on the balance sheet are presented as a percentage of total assets. And generally, line items on the income statement and the statement of cash flows are presented as a percentage of sales revenue. So what we're going to have is fixed assets as a dollar amount and also as a percentage of total assets. Okay? So we can see, based on all the assets that the company has, what percentage of those total assets are fixed assets. What percentage of those total assets is cash, receivable, inventory. Okay. Now, we've got an example here, part of the example that we have out of the textbook. We're looking at the balance sheet here, and we have total assets. This company has $26,495 of total assets, but in addition to the dollar amount, we also have the percentages, what percentage of total assets each line item makes up. And so, cash and cash equivalents is 10.9%. Marketable securities is 53.2%. And so we have this percentage for each individual line, and we see that total current assets is 69.4% of total assets. But what we have is each of these individual lines added together adds up to 100%. And so we're taking the total assets and breaking it down into each of the individual components of that total asset as a percentage. So this would enable us to compare a company that has $26,495 of total assets with a company that has $26 billion of total assets. Obviously, the company with $26 billion of total assets is going to have more cash and more marketable securities and more intangible assets. But this will allow us to look at that composition of the total assets between the small company and the large company. And not get lost just in the fact that the dollar amounts are so different from each other. And so this is the balance sheet where everything is presented as a percentage of total assets. On the income statement, what we're going to have is we're going to have things presented as a percentage of our revenue. And so revenue is 100%. And then we see that cost of goods sold is almost 31%. Research and development is almost 29%. Okay, we have the individual percentages for all of these individual expense lines. And we can see that if we start with revenue as a percent and subtract out 30%, 28%, 14%, that gives us our operating income as a percentage of the revenues, almost 26%. Okay, we're just kind of looking at all of the individual lines of the income statement as a percentage of revenue. So yes, the larger company that has $10 billion of revenue is going to have more research and development. Is it going to be 29%? Maybe not. Might be 25, might be 20. But by looking at it as a percentage of total revenue, we're able to get a sense of where that income, where that revenue goes for the small company and the large company as a percentage of that revenue amount. Okay? So that is our vertical looking, where we're looking at as a percentage of total assets, as a percentage of revenue. The second category of comparative financial statements is horizontal financial statements, and this is used to evaluate trends over a period of years for a business. So the first year is the base year, and that first year is going to be 100%. And then every subsequent year is going to be presented as a percentage of that base year amount. So if the number gets bigger, it becomes 103%, 105%, 110%. If the number gets smaller over the years, it becomes 97, 92%, whatever the case may be. This approach is also called an index number trend series analysis, where we have that base year where the value is 100% or 100 or 1 or however it is that we want to look at it. And then we grow or not grow, get smaller, the numbers based on or compared to that base year. But we also need to be able to calculate an individual growth rate, how it is that it's changed from one year to the next. And the formula is year 2 minus year 1 divided by year 1. We could do year 5 minus year 4 divided by year 4. That would tell us what the growth is from year 4 to 5. If we did year 5 minus year 1, that would tell us what the growth rate is over those 5 years. Okay, so we can compare how it is that an individual line has grown. So looking at an example here, we have our income statement. Here's the dollar amounts. Year 1, year 2, year 3. Year 1 revenue was $9,900. Year 2 was $11,100. Year 3 was $10,400. So it went up and then it went down a little bit. But what we're doing here is putting all of these as percentages. And so we see in looking at this that year 1 net revenues, everything for year 1 is 100%. Year 2 net revenues was 112% of year 1. And year 3 was 105% of year 1. But because year 3 is a lower percent of year 1 than year 2, we know that sales decreased from year 2 to year 3. And so we're just looking at different ways that we're able to express this to help us see trends over time. We're looking at trend analysis here. If we're looking at the balance sheet, we have all of the different year 2 and year 3 amounts, and then we can calculate what the percentage change is from one year to the next. Cash went from $1,800 to $2,895, and that was an almost 61% increase. Marketable securities went up by 52%. Accounts receivable went down considerably, went down 81%. Inventories down 20%. Okay, but we're presenting everything as a percentage of that base year, and then also here able to track that change from one year to the next. This is trying to make this analysis more useful. We want to be able to compare different sized companies. We want to be able to compare our company year over year, that trend. What's the trend for revenue? What's the trend for cost of goods sold? What's the trend for accounts receivable, inventory, payables? Okay, what are the trends over time? And so these are the different tools that we have available for us to do this. And when we're looking at vertical financial statements, we're getting everything as a percentage of revenue or a percentage of total assets. When we're looking at that horizontal, that trend analysis, we've got a base year, and every subsequent year is measured as a percentage compared back to that base year. So vertical, horizontal financial statement analysis, the tools we have to help make this financial statement analysis more valuable and more useful to us, because it allows us to compare companies of different size, and it allows us to compare the same company over time.